All right, so today's presentation is going to be about portfolio building. Portfolio building is one of my favorite things because I think, as a trader myself, I've developed from basically not really knowing anything, just being interested in the markets and getting excited and building automated models, actually learning how to build automated models, to working out how to put all the pieces together. And I think the natural progression is, for anybody, you need to start building some models. Then you need to be able to get at least one model working. And then once you're able to do that, you're able to start to combine multiple models. And that's what we're going to talk about today. Of course, with any portfolio building, there's many, many different ways to do it. I'm going to give you some ideas based on the way that I do it and some of the things that we do here. But of course, there's other aspects, and feel free to take some of the stuff that I give you guys and use it in your own way. We've got our own risk warning here, but basically same as Alan said, there's nothing here is financial advice. It's just educational content. And also we show some back testing and portfolios that we've put together. Of course, some of those actually might be real-time trading, but it doesn't mean that you're going to get those results going forward. There's no guarantees in the market, of course. There's a nice picture of me. All right, so just a little bit, as Alan said, I've been on the desk for 12 years. I basically came here because I wanted to learn how to build some automated models. Didn't really know anything about the markets. Was just interested in trying to make some money. But I was interested, and I thought back in the day, before a lot of people were automating, I thought, I don't really want to sit in front of the screen all the time, number one. And number two, I actually don't know whether my strategies can work, because I'm the sort of person who has plenty of ideas, but well, now a lot of them do work, but back then I didn't know whether they would work. And to be honest, a lot of them didn't work. So I started to automate, backtest, and go from there. This is in all my presentations. I try and keep them pretty interactive. So if you do have any questions, just fire them away. I've got the Q&A open, and I'll try and get to all of them as we go along. So the objectives for this masterclass or this presentation, we're going to try to understand how to build a balanced trading portfolio, learn some of the principles of correlation, exposure, and diversification. Now, I'm sure probably everybody here has heard of those things before. I'm sure you probably understand them. And one thing that I've come across working with clients is I think they understand the ideas of what those things are, but I still don't see anybody putting those things together, or very few people putting those things together. So I'm going to show you how we use some of those things here on the trading desk. And again, you can take that and use it as you will. We're going to combine multiple models into one cohesive system. Basically, what we do here on the desk, without giving too much away, is we trade multiple models. We trade actually over 70 different models, and we basically trade the book, trade the whole combination of models. So we're not interested in one particular trade. We have many, many trades open at any one time, and we're not even necessarily interested in one particular system. We trade everything together. I'm going to show you how to set up a portfolio inside our software, which is called TradeViewX, the platform that we've developed. I know people are probably using other things. Obviously, encourage everyone to come and work with us. You might find similar tools in your own software, but to be honest, a lot of the way that we do things inside X Manager, we built it that way because it wasn't available elsewhere inside the platform. So I'll show you how to set it up in our platform, and you can again take that and use that as you see fit. What we're going to learn, how to stack some models so that the strengths multiply instead of compete. Again, I got a question for you guys, if you don't mind. Who's already an automated trader here, and who's already trading multiple models? If you put it in the Q&A, it would be good to know, just so I got a bit of an idea who we're talking to. And also, I'll keep on going, but I'll keep an eye out. All right, Brett says yes, fantastic. So you can say yes if you're automated and you're building some portfolios. Let me know. I know Alan runs the special interest group, so a few people will be there from that. All right, Chris is not automated but trading multiple strategies. That's great. Jace is a no. All right, got a bit of a mixed bag so far. Okay, Rick started programming but hasn't optimized. All right, this is good. Sharon, no. Richard, yes. Nadine, not yet. Okay. So a bit of a mixed bag. So look, if anything goes over anybody's head and you've got a question, let me know. Otherwise, I'll just I'll keep going through and yeah, happy to take any questions throughout. I prefer it that way rather than hearing my own voice. All right. So we're going to talk about analyzing correlation and reducing overlap in systems. I'm probably going to give you a basic idea of it. And then again, it's, you can delve deeper into it, and happy to answer any questions here. All right, a few other people trading multiple strategies is Tony. It's good. All right. We'll talk about how to apply hedging logic to smooth drawdowns and how to optimize models for current market conditions. All right. So why portfolio building? Basically, single models are more fragile and portfolios are more resilient. So you can imagine if you are, for example, you have one strategy and it is long the market, whatever market that is, let's call it the index, then that strategy is going to work really well when the index goes up, but it's not going to work very well when the market goes down. So you can take that and you can apply that to any type of strategy. There's no strategy that's going to work in all market conditions. So, obviously you're going to get the benefits when the strategy is working well in particular market conditions. And then when market conditions change and they don't suit that model, you're going to start to have drawdowns. So what we want to do is we want to try and balance out the whole portfolio so that we can basically be more consistent and minimize those drawdowns. That might mean that, what it actually means, the interesting thing is what it actually means is you'll probably find that you're able to produce a better return. But the thing that and again, I don't know what you guys think, but the thing that I've seen over the 12 years here is that what a lot of people think they want to do is they want to have one model and they want that model to return, well, I've heard some pretty ridiculous things, but let's call it 50 to 100% per year. And I can show anybody how that is possible. And that might work sometimes if everything goes in your favor. But in order to do that, when the markets don't go in your favor, to push to get those type of results from one model, you're going to experience very, very big drawdowns. So what we try to do is have multiple models that just make a small amount of money, but have a very, very low drawdown. And what will happen is the profits will stack on top of each other. And if the models are uncorrelated, then they won't necessarily draw down at the same time. So we'll try and show you some of that in this presentation as well. As I said, different models thrive in different market regimes. So there's no one model that will work in all market conditions. And the really good thing about portfolio building, so, all right, there's another one from Scott. So he says he's fully automated with multiple strategies, but he knows they're correlated. All right, that's a good one. I've actually got some things you can consider, Scott, as well. So, basically, portfolio building, I think it does fit very well into algorithmic frameworks because for the people who said that they're looking to automate or they're doing some of the stuff manually, it's a lot more difficult, especially if you're trading shorter term models or multiple models, to be able to do that manually because you have to get your head around a lot of things at once and it just becomes very difficult. I mean, I think I can think pretty quickly and I can manage a lot of things, but I certainly can't manage as much as letting the computer do it for me and then overseeing it, if you want to call it. So I think portfolio building it fits naturally into automated trading. So why portfolio building? As I said earlier, what we do is we manage systems, not trades. I think Alan talked about that in the webinar he did with us. We look for we run multiple models, and to be honest, we don't really ever care about any one individual trade. We look at more the exposure, which we'll talk about later. True diversification comes from combining uncorrelated logic. I can't remember who it said that. I think the question's gone. It was Andrew, was it? He said they're very correlated. I'm not sure where the question was now, unfortunately. Scott, sorry, he said he's trading correlated models. Ideally, you want to trade a portfolio of models that is as uncorrelated as possible. That said, something that I'm a fan of in trading and in life is keeping things pretty simple. So it doesn't always work out that way, and there's other ways to mitigate those risks as well. But ideally, what we want to try to do is we want to try to be as diverse and uncorrelated as possible. The other thing about this presentation is that any of the techniques that I show you, even though I'm using TradeViewX platform, and I think we probably use the examples from some Forex portfolios and also some indices. Really, the techniques can apply to all asset classes. One of the things, again, that we talk about on the desk here is if you can understand how to trade and you understand how these concepts, then you'll know how to apply them for the markets that you're trading. So they're not, even though we might use FX and indices today, the techniques are not specific to those instruments. You can use them and adjust them as required for basically anything. And yeah, if you understand how to trade, then you can trade multiple models, multiple asset classes, and that's what we do here. We don't have any particular favorite. We'll trade pretty much anything that moves. Okay, so some of the challenges that we have when we're building portfolios, overlapping signals increase exposure risk. That was one for Scott before. He said a lot of the stuff he's trading is correlated. We're going to talk about that. I've got a little bit of an example in a second of how that happens. And we'll talk about that when we talk about exposure. Unbalanced weighting can skew the results of a portfolio. We'll talk about that as well. By the way, we've got a fair bit to talk about, so if I do leave anything out or you'd like me to go deeper, just let me know, and I certainly can. So if we're trading, say, so I've got a good example from FX and indices. Indices, the trade size is generally bigger, as in the minimum trade size is larger than the minimum trade size you can take with Forex. So, if we're if we're trading everything at the minimum size and we're trading a bunch of FX pairs and we're trading some indices, then the indices are going to be more heavily weighted in the portfolio just because the minimum trade size is larger. So we need to match that up as well. And again, you can apply that to stocks. You can apply it to anything that you trade. Correlated systems increase exposure. We'll give you an example of that as well. And again, we sort of touched on most traders stop at just building models, but this is the next step. So there's no one model that's going to solve everything for you. All right, so today's approach is we're going to run some back tests and we're going to assess the performance. In the platform, we've already got some stored back tests I can show you rather than sitting and you guys waiting for them, even though they're pretty quick. We're going to select some uncorrelated models and instruments, and we're going to adjust the weighting and exposure across the assets and then set them up actually inside our X manager. So I'll show you the full process or most of the process from backtesting a model through to putting it into a portfolio. Okay, so some of the things, some of the main points of this presentation: correlation, exposure, and diversification. Again, let me know if you've. Why don't we do it this way? Let me know if you've. Oh, well, let me know this. Let me know if you've heard of these things and you're pretty confident you understand what they are and how to apply them. Let me know if you've heard of them but not sure. Let me know if you've never heard of any of these three things. Give everyone a chance to type. Jace has heard of them. Richard's okay with them all. Yep, heard. Brett's heard and tried applying. Chris fully understands all three. All right. Tim's not sure. No problems. Rick, yes, very well. Excellent. Scott, all three. Okay, no problems. All right. Anne's heard of and used all. I'm not sure who that person is. BH understands all three. Peter heard and understand. Jeff, all fine. Ed, yes. Okay, good. All right. Well, you can tell me at the end if you learn anything new and specifically in applying them. All right, Tony, yes as well. Okay, so correlation, what correlation does is it measures how similarly two models or assets move over time. So do they move in the same way or do they move differently? High correlation. So if two models have a high correlation, then they're going to react the same way to market changes. So potentially if you have two trend models running in your portfolio and you're running them, especially on the same instrument or correlated instruments, then they're probably going to react the same way. okay, depending on the type of model. Low correlation means that the models behave independently, and then that's going to add balance to the portfolio. And we've got a really good, I think, good example of that later on. So you might have a mean reversion type of model and a trending type model. And one might be going long while the other one's going short, and that one's going to balance out your portfolio. We can talk about that again in when you trade CFDs, you trade FX with the index. You can actually go long and short at the same time, so you can balance out the I'll come to exposure in a sec, the exposure that way. If you're trading things like stocks, then you might have to, they might be across different stocks. Okay. So true diversification starts by identifying and managing correlation. All right, so here we've got a correlation matrix. This one is for FX, and there's many different types of things like this that you might see out there, but they all basically do the same type of thing. Another question for you guys: who's seen one of these correlation matrices? Who uses them? Anything like that? Anyone who's had any experience with correlation matrix? Yep, a few people there. Brett, yep. Scott, yep. Ed, okay, all right, yep. And Jenny's seen one for commodities. Yeah, they have them for all different types of instruments. A few no's in there as well, so that's good. They have these for all different types of instruments, and depending on the source, to be honest, they're going to be calculated probably slightly differently. I've seen ones. This one I think was actually for an hourly time frame. If you go to the website wherever I got it from, you can drop down the time frame and it will change it. And the correlations will actually change over the time frames as well slightly. I'm going to give you an example in a sec. One of the things that we do here as a professional firm, we actually try, like I said, we try to keep things very, very simple. And, there are these calculations that you can use for a lot of things in trading, and sometimes they can be very useful. Sometimes you can keep on calculating till the cows come home, and it's, you never do any trading. Okay, so these type of correlation matrices can be useful. For example, you probably know that the pound and the euro are fairly highly correlated. That usually doesn't change too much. Is it 92? Is it 87? Is it 75? It doesn't really matter, okay, because they're pretty highly correlated unless you really saw the two um, the two FX pairs really, really diverge. That would be the only time that it really matter, but it doesn't really happen. So they more or less stay pretty similar. Okay. So again, I've seen ones that are based on under between 0 and 1. This one's between 0 and 100. The basic gist of it is the higher the number, the more highly positively correlated it is. Okay. If it's a positive number, and if it's a negative number, then negatively correlated. Okay. So we'll go. I think I've got a picture where we can show you positive and negative correlation. Positive and negatively correlated, it's still correlated. So if you're trading, say, a mean reversion model, a model that goes against the trend, and the market goes up, then that model is going to be losing. One market goes up. And if you're trading something that's negatively correlated and the market is going down and that model is going short, you're still in a drawdown on both models. Okay, that's basically a negative correlation. All right. Okay. So Scott says, in the matrix is the goal to find a negative correlation, not just a low number. What it does is the matrix will just give you an idea of what the correlations are, and then it's up to you how you want to use them. You don't necessarily want to find a negative correlation because, like I said, they're still going to be correlated. Ideally, what you want to do is you want to find things that are uncorrelated. Okay, so like I said, that's in an ideal world, and depending on what sort of level you're executing trades at, how much money you have under management, the style of the models, all that type of things. Um, in the end, I'm going to show you when we put together a portfolio. Some of it might not matter as much as you think, but it is something to keep in mind. Okay, so you know what? I've mixed my slides up here. One sec, I'm going to go forward, and I think we can go back. All right, so remember we talked about before, we had a look at the matrix and we said that the pound and the euro versus the dollar are both highly correlated. I think it had, we'll go back a couple of slides. We said plus 92. Okay, so high positive correlation. Okay, so we can look at the matrix, or you guys tell me, if I put these two charts together, can you see just eyeballing it? Okay, eyeballing is actually a term I got from Josh Ritterman from last year's conference, who worked for Jump Trading. He's a professional quant. He's one of the best in the world. And a number of times he said the guys usually just eyeball it. Okay, so even though they've got some of the best calculations and the smartest people in the world that work for Jump Trading, for example, they might look at something like this and say, okay, is this correlated? So question to you, can you see by just eyeballing it that these markets are moving in the same direction? Yep, pretty much everybody's saying yes. So that's what I'm saying. We can, you can worry about the numbers till the cows come home, but at the end of the day, you can see that. Tim says correlation makes more sense now. That's good, Tim. Excellent. So basically, you can see they're basically moving in the same direction at the same time. All right, this is on the daily chart. All right. So to give you a bit of an idea, I think we've got the slides in the right order here. If we had a model that went long, let's call it a breakout model, sort of what I tried to draw here. I just drew it on by hand. It's not a particular strategy or anything, but you'll get the idea. Say we break this level here and we go long. We break this level here, we go long. We break this level here, we go long. Uh, here we break this level here, we go long, break this level here, we go long, and we break this one here, we go long. You can see the trades are more or less going to end up, almost identically overlapping each other. But even if not identical, you have 3 long trades on the euro and you have 3 long trades on the pound. So what that means, I'll throw that out to you guys. What does that mean? So if we have 2 markets, they're positively correlated, and we're trading the same model on each, what might happen? It's a good question, actually. I'm interested to see how you answer it. All right, Tim says double the opportunity. I like that Tim said that. Jay says increased exposure with an exclamation. All right, Scott says you multiply your gains, but also your losses. Andrew, welcome, Andrew. How you going? Andrew says double the risk. Okay, so it's actually very interesting how everybody thought about that. So double the opportunity. Yeah, sure, you do double the opportunity. You're going to have, if the trades go in your favor, then you're going to double the opportunity. Jace, good answer, says increased exposure. So, when we trade, we're not necessarily I don't know if I can get to show it in this presentation, but there's many models that can work. Okay, so we know that the models can work. Really, one of the things that we want to manage is the exposure. How much risk do we have on the table at any one time? Because you don't know whether the market's going to go in your favor or not. That's not really something you can control. You can give that your best guess, or by building and back testing the models, you can increase the probability of those odds going in your favor. But you can't control which way the market's going to move. One thing you can control is you can control how exposed you are to the market moves. So Scott says you multiply your gains, but also your losses. Exactly, that's the same thing. And Andrew says double the risk. All right. So and Chris says a pullback in one will be mirrored on the other. The losses or profits will double, says Brett. If one wins, they both win. If not, they both lose. They go up and down together, increases risk. Both will fall together as rise together. Correct. So, that's exactly what will happen. And it's really good to see that everybody's thinking about what will happen, because if you can understand what's going on, then you can work out how you want to apply that. Okay. So, for example, it was where was it? It was Tim that says double the opportunity. Now that's Tim's perspective, okay? And Tim's not wrong. Depending on how many different strategies you're trading, how many instruments you're trading, how much money you have in your trading account, you might want to actually do that. You might want to you might want to trade 2 correlated instruments, with the same model, because you might have, you might want to, they're not going to move exactly the same, and you might want to increase your exposure to, a particular direction or particular asset class. All right. But what will happen is you will increase the exposure. All right. We'll go back. So I messed the order up of these slides. This one here, I actually drew some lines on it just so it was a little bit easier to see. So here we have the dollar Swiss franc and we have the Aussie dollar. So on a scale of, let's have a guesstimate. How would you on a scale of, let's use that 1 to 100, how correlated would you say these are? Are they highly correlated? Means it would be sort of plus 100. Are they highly positively correlated, plus 100, highly negatively correlated, minus 100? Or are they somewhere closer to the zero, either minus 10, minus 20, or plus 10, or plus 20, meaning less correlated? So again, we're just eyeballing it rather than using the matrix. So Robin says 50, Brett says negative 20, somewhat negative, maybe 60, 70. All right. Less correlated, maybe negative 20, about 50, 50%. Okay. Probably close to zero. All right. Again, see everyone, it doesn't really matter what, there's probably some different descriptions of the same thing. To me, it doesn't matter as long as you understand it. We'll go back to the matrix if we can in there. So we had, what did we have? Sorry, we had the dollar Swiss franc and the Aussie dollar. So I picked that one. The Aussie dollar and the dollar Swissy is negative 49. Okay, so it's negatively correlated, about sort of 50%. All right, so it's probably one of the more uncorrelated uh, combinations. All right. So you could probably see again just by eyeballing it. Here the Aussie goes up. It peaks here. Here it hasn't peaked at all on the dollar Swissy. Here the dollar Swissy peaks. It hasn't here on the Aussie. Here the dollar Swissy's basically taken a big hit. Nothing's really happened here on the Aussie dollar. So if you're trading the same model on these two instruments, they're generally speaking not going to be very correlated. Okay, so that's basically correlation and how you can apply it. And then it's up to you how you want to apply it, whether you want to have more exposure or you want to have less exposure. Okay, it's just something to keep in mind. All right, so a question here from Scott. If you had two perfectly but negatively correlated systems, wouldn't you just flatline your returns? How do you mix these so you don't cripple your returns, but of course can reduce your risk? It's a good question from Scott. Basically, what will happen, let's go to another slide. Okay, let's use this slide for example. So let's say it's actually a really good question, Scott, and it's not necessarily a simple answer. It's going to come down to the types of systems that you use. And this is where with trading, the great thing about automation is you can backtest and you can put things together. And as a trader, what you need to do is you need to understand how your models work so that you can manage that. I'm going to give you one example. We might actually even show it a bit later on. Actually, you know what? I'll come back to it, Scott. Let's pop that in the back pocket for later on. I'll come back to it. All right. Okay, so exposure. We'll get into exposure. So now that we understand correlation, let's talk about exposure. These are some key components of portfolio building. So your exposure grows when correlated systems trade in the same direction. So just like everybody said before, we have correlated systems and they're trading in the same direction. And that's on, I'm going to go back a sec. So that's what we're talking about here. Okay, so you've got here what we have is we have the same system on correlated pairs, okay, highly positively correlated pairs. But really, it's pretty much the same thing as having two similar systems on the one pair, okay, because that would do the same type of thing. If you have two breakout models and you run them both on the daily time frame, they're probably not going to be that different. They're all going to have probably long exposure. They might not overlap exactly, but they might, you're going to have more long exposure. Oops. All right. So multiple models trading the same instrument equals a concentrated risk. So again, yeah, basically, if you're throwing more models on one instrument, you're going to have more, and the models are correlated, then you're going to have more risk, okay, on that particular instrument. So what we try and do is we try and diversify across basically everything. We try and diversify across multiple instruments, multiple time frames, and multiple logic types, as in multiple strategies. I'll go back again just to sort of explain. So you might have something like this. Again, depends on the strategies. A few good questions there. I'll come to those in a sec. This is one. This is sort of coming back to something that Scott said. This is a day. This is a daily chart. So you might have a breakout here on the daily, and depending on the rules of your system, I don't know what the system is. This one here was just for illustrative purposes, but you might have a fixed profit target on this breakout trade, and you might end up out of the breakout trade here on the daily. Okay, but you might also have other models that trade on the lower time frame, and they might enter a breakout somewhere around here, and they might actually be out, right, before the daily model takes the trade. Okay, so it depends what type of models you're running and how you combine them. So you may see some of those stack, but what might happen is you might not have, you might be able to reduce the exposure very quickly because you're in and out of the trades on the shorter time frame. Okay, there's plenty of things that you can think about, and like I said, I'm going into a bit of detail, but we try not to think too hard about it. I'll show you how we sort of manage it in a little bit. Okay. So exposure control will smooth the equity curves and reduces large drawdown. I've got a pretty good example of that in a second. All right. So just a couple of good questions in there. So Mark says, assuming you or the system needs to know when to turn on or off. That stuff, Mark, is built into the individual system. So I was thinking about, there's plenty of things I can put in here today. It's probably a different presentation, I think, about when to switch them on and switch them off. And yes, we do build that into the model. So when we're building these portfolios, that factor of that model switching on or off is already occurring. Okay. And I'll come back to exposure somewhere in here again, and I think I can probably answer that. All right. So in relation to exposure, this is basically how it works. If we have, let's call the trade size 1, okay, we have exposure here is 3 long, okay, we have 3 long trades, and here we have 3 long trades, okay. So exposure across the 2 is 6 long, all right. Or if we had similar models running on the same, it would be our exposure to the euro would be 6, all right. On the flip side, let's say we had something that was doing this. I didn't put this in here. I'm thinking of it on the fly. Let's say we had one particular type of model that's going long on this breakout, but we have a different type of model that's like let's call it a fading model or a mean reversion type model. So once this move is over, or once this move is exhausted, we have things that calculate that. It would take a short, probably somewhere in this section in here. Sorry, it's not bigger. And that might have a shorter profit target. So we might be out of that short here. Okay. So what that will do is while we're still in the long here, we might still take some profit on a short. If we had 1 long and we had 1 short here on the same instrument, then our exposure would be 0. Okay. That is basically, that's hedging. And that's what we're talking about. We're saying if we have models that aren't correlated, they can reduce the exposure. I hope that was. Let me know. Did you guys understand that, or do you want me to maybe try and explain that again? So basically what I'm talking about is you have one model going long and you have another model going short based on a different set of rules. If we had hypothetically 1 long and 1 short, the exposure will be 0. So at, for a period of time. Okay, everybody understands that. Good. Okay, so this is one of the tools that we have in the platform. It's called the exposure monitor. This is inside the TradeView X platform. So this is something that we look at very, very heavily. Okay, so the way that it works, basically, if you hover on the the red bar here, works like this. So I did it on this one because otherwise it went off the screen, but it works a bit different. So say you're Aussie New Zealand, you might have multiple models running on the Aussie New Zealand, or whatever stock or whatever instrument you're trading. Okay. And so you're going to have some that are going long, you're going to have some that are going short, and they're going to be on different time frames. So at the end of the day, what we really want to try to do is we want to try and keep this exposure here to the Aussie New Zealand below a certain point. Okay, because I won't tell you the exact rules that we use, but let's say hypothetically we have $10,000 in a trading account. We don't want to have more than a certain amount of exposure on that size trading account. Otherwise, the risk becomes too great. So if you can imagine this, the way it works here, it's red because whichever models we have at the moment are losing, and it's down $116, and that might be across multiple models. And the exposure, I'm not sure what it would be here, but it will look like this. It will say the net position size. It's on the left because the left is short. Okay, so we're in the sum of all our trades is we're losing. Okay, and we're losing, the amount we're losing is 116.73, and the exposure, I don't know what it would be here, but it will look something like this. It will tell you our net position size. So we want to have a maximum net position size per, let's call it $10,000 in the account. Okay, so once that gets exceeded, then we think that's becoming too risky. So when we build the portfolio, all else aside, what we want to try to do is we want to try and maintain that the exposure doesn't get above a certain point. Okay, does that make sense? Let me know if that makes sense, because that to me is the single biggest thing that is important to me in building a portfolio, is keeping that exposure below a maximum limit that we have. So let me know if that makes sense. Yep. Makes sense. Okay, good. So just lock that in. If you're using ChatGPT now, it says memory updated or whatever it says. Lock that one in, because to me, that is the single most important thing. We use this exposure monitor a lot. Okay, because if you set the portfolio up correctly, ideally, you should never exceed that maximum exposure. Okay, and if you don't exceed that maximum exposure and the models themselves are high probability systems in that they all can make money, then there's really not anything to worry about when you're running your models. If you do start to exceed that, then that's when you have to, that's the issue. Okay, that's the main issue. All right, so to give you a bit of an idea, this one here, the way it works, it will work for each individual currency pair. So this number here would be the net exposure on from any models running on the Aussie New Zealand. Over here, we have the base currency. So the base currency is the Aussie dollar. And you'll see here it says 130. And that is made up of the $116.73, $130.30, sorry, and the $13.57 we have exposure to on the Aussie CAD. So again, this is something that we look at. Remember, we talked about before. We talked about for I don't know if all the things are still in there. With somebody that said you can basically said you have you're able to make more money when the two markets move together. You can, okay, but you can also lose more. So this gives us our exposure to the Aussie dollar. How exposed are we to the Aussie dollar? So again, ideally, that's something that we want to keep within a certain limit, because when the different currency pairs move, however they move, we're going to our exposure to that one instrument is going to determine how much we're making or losing. So that's something else we probably want to consider. Okay, how much exposure do we have for currencies with the base currency? If you're not doing currencies, if it was all on the one instrument, then you're just looking at the one instrument. All right, so that's exposure. Exposure, like I said, lock that in. I think if you take one thing away from today's presentation, I think the most important thing is exposure. If you get that right and you have good quality models and you run multiple models, then if the models are running well, then the rest will take care of itself. Okay, if you can keep within the maximum exposure. All right. So diversification. So like I said before, we want to blend as much as we can. Different models, trend, mean reversion, breakout, and volatility. We want to trade uncorrelated markets, FX, indices, commodities, and crypto. We trade, like I said, pretty much everything. There is a level of correlation between a lot of different things, so that is going to be unavoidable. But again, if you keep it below the maximum exposure, then that's the main thing that we're looking to do. Adjust the weighting so that no single model dominates the results. To me, again, that's sort of common sense. If you have 10 models that you're running and one of them contributes 90% of the profit or losses, it's not really a balanced portfolio. So it's something to consider. And diversification is about balancing the risk, not necessarily the number of systems. So just because you have more systems doesn't mean that you have a more diverse portfolio, because some of those might actually be correlated. And depending on how much money you've got, obviously there's only a certain amount of models you can deploy. There's going to be some type of a limit. All right. So here's an example I want to talk about. We're going to talk about, well, pretty much all those things we just talked about. So let's look at it. This one is going to work from this perspective. We've got one particular instrument and we've got two different systems. Okay, and I'm going to show you how correlation and basically exposure works. All right. So let's say model one. Let's just call it buy the dip. I made these up. They're all fictional. And it buys there. Okay, and it buys here, and it buys here. And that's the model. Okay. And then say model two is a breakout model. So it buys here on this breakout. Again, they're made up, so don't worry about the signals per se. Buys here and it buys here. Okay. So let's say we're still in all of these trades at this point. See if we learned from about exposure. Do you want to tell me what is the exposure? I just call them all one. Okay. So each trade is one. So see if you can tell me what the exposure is. The net exposure. So that's what we talk about on the exposure monitor. That's what we talked about a bit earlier. All right. All right. So we've got 6. Rick's added that it's a tragedy, but Rick, I'll come back to that in a sec. 6. Okay. So the exposure is 6. We would also say it's 6 long. Okay. So we're net long 6. That means that our exposure, it is 6, but we would say we're net long 6, which means if the market goes up, then we're going to be making money at, let's call it 6 lots, for example. If it goes down, we're going to be losing money at 6 lots. Okay, cool. So let's say the way that both of these models work, again, I'm not saying this is how they should work, it's just an example. So that both models go long and they both average in. Okay, so what they do is they're going to keep buying. This one's going to buy, it's going to stay in the trade. This one's going to buy, this one's going to buy. It's going to keep on adding to the position, dollar cost averaging or whatever you want to call it. And this one's going to do exactly the same thing. Okay, so both models, you've got two models that have the same management logic, if you want to call it, but they've got different entry criteria. You can probably see that what's happening is we're stacking up the risk, okay, because they're both doing exactly the same thing. We're increasing the exposure, and we're going to be in a drawdown on both models at the same time. All right. So let's just say hypothetically, at this point here, we decide to close all the trades. Okay, let's have a look at what that looks like. So in this case, that one would lose. I actually measured these from the actual price, 1,534 points. This one would lose 1,638. This one 1,156. This one 1,003. This one 503. This one 763. Okay. So the total drawdown of the systems, the two systems running together, because they're both the models are correlated, and the if you want to call it, the instruments are correlated because it's the same instrument. But this would be, let's say you were trading one model on the euro and the other one on the pound, like we showed in one of those first examples, you get a similar type effect. So you can see how the correlation, the two similar models, whether they're on the same instrument or correlated instrument, is going to perform similarly. So total drawdown would be 6,579 points. Okay, so just remember that, write it down somewhere, 6,579. Store it in your memory bank like ChatGPT. Oh, Rick says that means that the model probably shorts when the markets goes up. That's why it's a tragedy. Got a really good one for you here, Rick. It probably would short when the market goes up. Correct. I've got a good one for you. And this is the great thing about automated trading. And this is why I'm going to see if I can explain this and see if you guys can understand. By the way, I'm not saying these are the best models to run, but I'll give it an example. All right. So this is example number 2. Okay. So model 1 is going to buy the dip again. So it's going to keep on buying. And just for the purposes of the demonstration, it's going to do the same thing. It's going to average in. Okay. All right, and model 2 is a breakout, but this time it's going to take short trades. Okay, so it's going to take breakouts only to the downside. All right, so let's say we break again, it's just eyeball drawn in. So let's say it takes a short there. We take a short here on the break of this. So basically what the model said is one model thinks we're going to get a reversal here. The other one says if we break this low per se, we're going to go short. This model says if we break this low, we're going to go short. If we break this low, we're going to go short. Okay, so they could be 2 different types of models you could trade. And let's say that what model 1 does, again, for the purposes of the illustration, it averages in the same as it did before. So these are actually the exact same trades. I didn't change the white ones at all. So same model as before, the buy the dip. Okay. Now, let's say, again, at this point, we decide we're going to close all the trades out. That's it. All right. So I'm going to ask you guys, what do you think is going to happen this time? So model 1, it's going to hold the trades. It's going to buy against the trend. It's going to buy. It's going to buy. All right. And model 2, it's going to sell. It's going to sell. It's going to sell at pyramid. So it actually adds to the trades. Again, I'm not saying these are the best models, but it's just an illustration. So tell me what you think is going to happen when we close out all the trades at that yellow line. All right. Rick thinks it might make a bit of money. And by the way, we'll go back here. Someone answered a question I didn't ask, but that's okay. What's the exposure here now at this point? All right, Chris is sort of close to break. I mean, Rick says 0. So the exposure at this point is 0. So remember, we want to keep a low exposure. Low exposure is good. Okay. If the models all do what they're supposed to do and we keep the exposure low, that's a good thing. So as we were taking these shorts, we're decreasing the exposure. We basically had 1 long here and then net 0. 1 long here because those 2 net each other off. 0. 1 long here, 0. So we're keeping our maximum exposure is 1, whereas in the other example, our maximum exposure got to 6. Okay, so now we're trading different models that aren't correlated on the same instrument. Okay, as long as they're all the same size. Correct, Rick? Yes, that is correct. So, all right. So basically, people are saying the longs are going to lose and the shorts are going to win. So one thing we did in this example, and this is on one instrument, but you could do this across different FX pairs. You could do this across different stocks, the same technique. Remember I said before, if you understand the technique, you can work out how to apply it for the markets that you trade. So what will happen? Let's have a look. All right. All right. So Chris says, does pyramiding affect the amount of exposure? So to answer that question, in this particular example, and this is where you've got to work out exactly what you're doing. You've got to work out what your models do and how you're going to manage all of that. Does it affect the amount of exposure? I mean, it does in a positive way in this case because we're keeping the exposure pretty close to 0. If you didn't have any models that were going long, then that would increase the exposure to the short side. All right. So this one here lost 1534, same as before. This one here made 1174. This one here made, lost 1003. This one here made 720, lost 503, made 393. Remember, this is just an example. This is not really the ideal way that you would want to have your models running. And remember that these models would probably run independently of each other. Okay, but the exposure on the instrument is going to be, we look at that as 1, and that's what we're talking about when we said earlier. We're not trading one strategy or one model. We're trading the, if you want to call it, the book of models, and we're looking at the exposure across all the different strategies that we have. Right? This is just 2 to keep it simple. So in this case, our total drawdown was negative 753. I can't remember the number before, but the number before, right, was about 6,000 and something. So just by having another model that's doing something different, okay, we're able to to reduce the exposure, which is a good thing, and we're able to reduce the drawdown. So that's how uncorrelated models running on the same instrument or correlated instruments can reduce the drawdown. Now I've got one for Rick, okay, because remember these systems are going to operate independently of each other. Now, let's say that we're running, and on FX you can do this, okay, and you can do a similar thing, but with you have to manage it differently on different instruments. What you can do is you could literally run these two systems exactly as they're built here, all right. And then what you could do, all right, is you've been able to let's have a look. Sorry, I think there's a few questions here. Okay, so let's say that let's say that uh, let's say we are actually running these systems. All right, at this point here, this is going to be losing the difference between 1174 and 15. We've gotten about 400 points. Uh, we're not going to be in a big drawdown the whole way down. The maximum drawdown we're going to have is this 753. Okay, so we're able to maintain the drawdown on our account, and we're also able to limit the exposure on the account, which means if there's a big move in either direction, the risk of a big loss is low. Okay, now let's say instead of closing the trades out here, let's say we did this. This is one for Rick. Okay, let's say what we did is we closed out the short trades here because this is for another webinar. But let's say we talk about a regime change, or we talk about on the desk momentum shift is something that we use. Let's say we have something that identifies that we think that the momentum is going to shift here, and let's say that we close out the short trades here, but we leave the long trades open. Right, we now have an exposure of 3, and then as the market moves back up, you can make money on these long trades. Okay, you would have made money on the shorts, and then probably by here, to be honest, you would be at least 0 on the longs, probably in some profit on the group of longs. Okay, don't know if that makes sense to you guys, but again, depending on what the models do, you might be able to stay in all those trades. You might be able to take profit on the short trades, and then the long trades will you might even be able to take profit on the group of long trades, okay, in an ideal scenario. All right, I've got a question there. It's a little bit longer question from Scott. He says, when I run a short strategy, short availability and too short borrow fees were frustrating and can't be modeled in a backtest. How do you deal with that? For us, in the platform with CFD trading, you will have swaps, which are the borrowing fees, if you want to call it. And you can model those in the backtest with our backtester. It does include swaps. And basically the way that number one, you can model it. And number two, what we do is we look at the system as a whole. It is probably a bit of a longer question. Maybe if you come to the conference, happy to have a chat about that one, or maybe we'll meet sometime, a bit more longer chat, or I'll do another webinar. It's probably a bit longer, but yeah, you can actually model it, and you can deal with it. You will pay swaps or borrowing fees. Just have to make sure you incorporate that into the model itself. All right, I'll press on. I realize I've probably taken a bit longer. All right. So Tim had a question before. I'll go back. I'll answer that one quickly. He said, wouldn't you have got out of the longs before taking the shorts? It just depends on what the model is, Tim. So I have models that will average into trades, and they will stay in there, and they will get out based on the group of trades. Okay, they start small, and they don't exceed the maximum exposure that I've set, and then I'll get out based on a group. So that model might stay in the trades. Just depends on what you build. So I'm saying it's up to everybody what individual models you run, but this is just an illustration of how the two can work together. Let's say hypothetically though, I'll give you another example. Let's say your model it went long here and you have a stop here. You get out of this one, okay? And then so you're net 0, now you're 1 short, and then you have a profit target here and you get out of this one. Basically, the profit from this one is going to more or less cover the loss from this one. And then Same with the other ones. It's obviously it's just an example, but that's the ideal scenario. So you can still do it where you get out of the trades. Just depends on what your models do. All right. So it actually comes back to the process that I use here. So step one is model selection. You have to understand the model that you're trading. Okay, what is the model actually doing? That probably answers some of Tim's question. Does your model average in? Does it get out of the trades? How does it actually work? If your model averages in, then how many positions can it take? And then what is the maximum exposure that that particular model could have? All right, so you need to understand exactly what your model is doing. Hopefully you built it yourself, so you should. But it's maybe it sounds silly, but it's actually again, it's the other thing to lock in the memory. Number one, exposure. Number two, you got to understand what your model does so that you can understand the risk of each individual model to start with before we put the portfolio together. All right. Step two is back testing. We back test on multiple assets and timeframes. I'll probably come back. I think now is going to show a bit of an example on the platform. All right, so what we've got here, this is the platform. I won't go too heavily into how everything works, so see if you can follow along. But basically, we have here the backtesting engine, okay? And in the backtester, we've actually saved some backtests, all right? So I'm going to pull up a few that you can have a look at, and I'm going to explain a couple of different scenarios about different things. All right, so first one I'll do. It's not the one I want, sorry. It's pretty cool, this actually. It actually just, you can save all your backtests, so they're there at hand. I think it's this one. Okay. This is one of the models I showed at the conference, our conference last year, or something similar. Again, I'm not going to go into the ins and outs of the model or say whether it's the best or it's the worst or what it is. It's just an example for today. So this is the back tester. What you can do, again, the first thing I usually do is when I do a back test, so assume I've already built the model, I know how it works. The take keep optimizations and all that's a different story. Pretend there's no optimization here. We can always drill down further into these things later, but I'm just going to use it for the illustrative purpose of the portfolio. So I can see that this model can work on a number of FX pairs. Okay, just again eyeballing it. All right, it's obvious that it can work. All right, that's the first thing I want to look at. Does the model actually work, or can it work? Yes, it can. I can always go in and see if we can improve different bits and pieces later. All right. The next thing that I want to do is when building the portfolio. So we've got the model, step one. We've done the back test, step two. In a platform, you can just back test multiple instruments at the same time. So I've run it over a bunch of FX pairs. And then what I do is I go to this view we have is called tabular view. And then I want to find again, this is a general way of doing it. In reality, probably drill down a little bit more, but it's not that dissimilar. Okay. I'm going to go and look at the drawdowns, okay? Because what I want systems with a low drawdown. I'm not looking for the models that make the most money, okay? So step one, remember, understand how the model works. I understand how this model works. I built it. This particular type of model can average into trades, and I know what the maximum amount of trades it can average into, and I know what the maximum amount of exposure the model can have. Okay, so knowing all that stuff, I'm just looking to see which particular instruments have the lowest drawdown. Okay, that's the first thing I want to look at. So I just sort it by drawdown. Okay, and obviously they've got to be able to make some money. The second thing I want to sort of look at is, I've run it on multiple instruments. Again, I know the model. It's a mean reversion model. It's going to work better on particular instruments that I usually trade mean reversion type models on. But, all that aside, pretend we're looking at it fresh. I know as well that anything that's got the yen pairs is typically not very mean reverting, and you can see that hasn't worked very well on the yen pairs. It's got a much bigger drawdown. Okay, and then things usually like your Aussie dollar, Aussie CAD, those are the kind of things that usually tend to mean revert. Okay, and there's a few other ones in there, bits and pieces as well. So generally speaking, building this portfolio, remember what we can do is we can go and look at the correlation matrix. We can see what's correlated, what's not, all that type of thing. And that's one part of it. But the other thing that I can do, like I said, I'm just going to keep it pretty simple. I'm going to find the things with the lowest drawdown. I'm going to find 5 or 6 of them. Okay. And what I'm going to do is let's just take these. So I don't want to include any of the yen pairs. I'll take it. How many is this? 1, 2, 3, 4, 5, 6, 7, 8. Okay. So what I'm going to do, I'm going to go and export these ones. 1, 2, 3, 4, 5, 6, 7. Okay. And I'm going to go click this, and I'm going to export this to our analyzer. And you can see it's down here. This is the export. Okay. And then what I'm going to do is I'm going to go in here, and I'm going to select those 8 that I just exported. 1, 2, 3, 4, 5, 6, 7, 8. Okay. And then I'm going to go and create a portfolio. It's down here. The model's called MMR. All right, so I'm going to go create a portfolio. I'm just going to switch them off because I don't need to see those anymore. I'm going to show you some other portfolios as well that we've created so you can have a bit of a look. All right, so then we're going to go and have a look and see what happens when we combine all of those together. Okay, so here it is, MMR ATAA. All right, so the way that the analyzer works is it will put everything on a $10,000 account. When I do the testing, it's all done on a $10,000 account and everything is set up for a $10,000 account. But all that stuff you can adjust. Actually, the question somebody had before, we go back to the tester. You can see here, so you can enable swaps. So you can we're talking about that before. With someone you can enable swaps, you can change the leverage, you can change the balance and the currency and all that type of stuff in the testing. All right. So what this has done is it's put together a portfolio, and it would have taken all 8 of these instruments and it's allocated $10,000 to each one. So this is as if it's running on a $80,000 account. Okay. So what you can do is you can play around with some of this stuff in here in the analyzer, and you can say, okay, you can filter it, and you can say, what if I ran it all on a $10,000 account? Okay, because I know they're all FX pairs. I know the trade size that it trades in. I know the model. I know how big each. I'll explain that in a sec, actually. All right. So I know how big. I know the maximum exposure that each model can get into, and it won't. I know what the maximum exposure is. The next thing that I would do is I would probably have a think about in my mind how correlated are some of them, because that's going to make the drawdowns happen at the same time. If you have a look here, remember it's the same model on multiple instruments. You can even see on here. You can sort of eyeball here, and you can see the instruments that are going to have the drawdown at a similar time. Settings. So if you have a look at, see if we can find some. All right. Again, remember we talked about the pound and the euro are fairly correlated. You can see that the drawdowns here are pretty much happening at a similar type of time. Okay, so what we want to do is ideally we want to avoid this type of scenario, putting both of those in the portfolio together. However, depending on the size of the portfolio, it might not necessarily be an issue. All right. So what we can see, if we were to run them all on a $10,000 account, this is over 5 years of testing. These are the returns and the drawdown. What happens in reality is we've got to always expect that the drawdown in reality is going to be more than in real life. We have a calculation, it's a pretty simple calculation that we use in order to determine the risk. But let's just say hypothetically, you assume that the drawdown would be twice as much in real life. You're looking at about 30% drawdown. And the reason I say that is because other events are going to happen that have never happened in the past. Let's just say it gets to 30% drawdown. You have to ask yourself whether you can stomach that. Okay. So basically looking at this, we know that the models can work, so that part is basically taken care of, and they're going to operate independently of each other. The next thing is we can look at the correlation. We know there's going to be some correlation between them. If we wanted, we could take some of the correlated ones out, and we could only, we could say there's two forex pairs that are highly correlated. What we could do is we could take one of them out, and then that's probably going to reduce the drawdowns occurring at the same time. Okay, we could allocate more money to it and then leave both of them in. So let's say we're to take one out. Actually, we can probably do that now. So why don't you guys give me something you want to take out, or give me two things you want to take out, and I'll take them out of the portfolio, and we'll re-look at it. Okay, so this is where it's going to come down to you, how you want to build your portfolio. And you can remember those figures as well. All right, so I'm going to take out the Euro Swissy. All right, I'll tell you what I'll do. I'll take out the Euro Swissy. All right, and we'll see what happens. I don't know if I can take it out from here. I don't think I can. I think I have to do another portfolio. So we'll do another one. We'll leave out the Euro Swiss. Was there anything else you want to take out? Okay, no, we'll leave those. Okay. And we'll go create another portfolio. Of course. No. So that's this one here. So remember 193.37, 14% drawdown. We're going to put this one on the same size account on 10,000. Not sure why. I don't think that's updating. What did I have in this one? Something doesn't look quite right there. What have I got here? Yeah, I'm not sure what we've done there. I'm surprised that that's reduced it by that much. It doesn't seem quite right. Oh, the first portfolio had the S&P 500 model, did it? Oh, okay. Sorry about that. All right, no problems. I see. All right, okay. Let's go back a sec. All right, thank you. Sorry, I didn't see that. All right. So we'll go. I'm going to get rid of this one. We'll go recreate that. The joys of live television. One, two. All right. I think that looks right then. Okay, so this is all right. Here we go. So here's all the original pairs, I think, and then the other one should have no Euro Swissy. This one should have no Euro Swissy. Okay, so this was the original one. Sorry, this was the original one with the Euro Swiss in it, and this was the one we removed. Actually, the reason why it was so big before and the drawdown was so big is because we had the US 500 in it and it trades at a bigger size, and that's actually a perfect example, right? See, I actually did that on purpose, all right, because it's a perfect example of how you can get the weighting wrong in a portfolio because you see that the US 500 in relation to their position size was probably causing the most drawdowns and the most wins. So I actually didn't do it on purpose, but I was going to show something similar later. So that's exactly why you need to make sure that the weighting is correct in your portfolio. But this is correct now. So, I mean, we have this one. This was the original one with all the instruments in it. To be honest, on the $10,000 account with a drawdown of 3%, I don't think we need to remove the Euro Swissy from this one. Uh, where is it? There we go. I don't think we need to remove anything from this one. I actually think that's fine. So that's basically what it looks like. So before, remember, I was saying the correlation does matter, but it can be important. But at the end of the day, really, what I'm looking at is I'm looking at exposure per. I'm looking at the exposure per instrument, and then I have a somewhat of an eye. I just want to make sure that I don't put too many correlated pairs together. But on a $10,000 account, that's probably going to run okay. The great thing that you can do with automated trading is you can now go and run this on a demo account, and you can see if it mirrors that in real life, and it's going to give you a bit of a better example of what that feels like in real life and whether it mirrors that. And generally speaking, it should. If you want to, and you still think 3% drawdown is too much, then you could do this. You could always you could run it on a bigger account size, so you can simulate that here with 20,000, and that's what you'd get. On the flip side, what you could also do is I wouldn't run it on any less than 10,000, but if you wanted to take on more risk, you could increase the trade size accordingly, or yeah, you could run it potentially on a smaller account. There's some other things that you have to look at. So that's the general gist of how we put a portfolio together. Step one, get the models working. Step two, try and run things that aren't too correlated. And basically put them into the analyzer and have a look at what they look like. And from there, we can sort of adjust. Again, it's not a matter of just taking things out that are not working. There's got to be a reason for taking them out. That's probably a conversation for another presentation. All right. So we did step three. We did the asset selection. So we did the correlation and we looked at the performance and drawdown. All right, question from Scott. Is your portfolio allocation dynamic as the portfolio trades or static when you first started trading the portfolio? So I'll go back. It's actually a good question from Scott. So something like this on FX, basically what's going to happen is, again, I know what the model is. The model is going to continue to do the same type of thing. If the model itself breaks down, or it breaks down on certain instruments, then we might have to look at taking those instruments out. This particular model is a pretty robust model. It's probably not going to break down as such, so therefore wouldn't really need to change it. And one thing that I do is all the allocation is the same. So the exposure per instrument is the same for that particular model. So that doesn't change. It's already balanced in that way. The trade sizes are the same. The amount of trades, the exposure is the same. The number of trades is probably roughly similar. So everything is already fairly balanced. The only reason I would change that is if for some reason the market dynamics on that particular market change considerably and that model no longer works on that instrument. Otherwise, I would pretty much leave it. Okay. What you'll see happen, I can probably actually show you in a second what you sort of see happening. All right. I see Alan's posted in there as well. So you've got come to the conference if you want to see some more stuff. You'll get to see some really, really good stuff there. And we'll give you guys some good pricing. All right. I realize I've been talking for a long time, so I'll keep on going. All right. We did that. We put it together in X Analyzer. Adjusting the weighting. We had a little bit of a look at that in relation to, by accident, the first time we had the first portfolio that we did, we had a S&P 500 in it, which trades at a bigger size. It trades at 10 times the size. And that's why what would have happened is you would have seen that you actually saw it. I mean, we can probably just quickly put it back in. So it was this one. And then we're going to put the US 500. So just remember this. Okay, I'll put it on. I'll do them both on 10,000. All right. So this is without the US 500, then S&P 500. Okay, I'll do one with it. All right. Sorry. I'll tell you what, I'll just take one of them out just so we get the same number in there. All right, that's on the 70,000 odd. We'll do it on 10,000. Okay, so you can see here by adding something that's weighted differently into the portfolio. We had this one here, which is returning 62% over the 5 years, 3% drawdown. And just by adding one instrument with the incorrect weighting, it's really skewing the portfolio. So even though you can see here, that's why I didn't pick it up at first, the US 500, because we had, where is it? There we go. You see, it has a reason. This is based on the number of trades. So here, 445 trades here in the pound New Zealand, 369. I didn't notice it at first when I put it in. I was trying to work out why is the return so big, because basically the number of trades is actually quite similar to the other instruments, but the position size is 10 times as large. Okay, so therefore it's going to skew the results of the portfolio. So we did talk about that, about how you have to balance it. Here's a good question for you guys. Let's say that the trade size of this is 10 times as large. If I wanted to run this in a portfolio with these other instruments, I'd definitely have to run it on a bigger account size, right? Let's say instead of say that would go 100,000. Okay, but what could I do? Say, remember the trade size here is 10 times as large as any of these, same model, but 10 times as big. What could you do to balance that out? Because it's taking roughly the same number of trades. It's a good question. So same amount of trades for this, but the trade size is 10 times as big as these. So if you wanted to balance that out, all right. So Chris says, okay, cool. And Andrew says, reduce the trade size. Basically, this is already at the minimum trade size. So what you would have to do is basically, I'll give you the answer, but you're on the right track. You have to 10x the trade size on these and then go to a bigger account. Okay, that's what we did. So we went to 100,000. You can't reduce this any more. It's already at the smallest size, so you would 10x these, and then that would be reasonably balanced in that portfolio. Again, probably some other things to look at, but reasonably balanced. And I prefer to probably keep all the FX pairs together. It's just a lot simpler in terms of managing it. All right. Okay, so step 6, setting it up in X Manager. What you can do is with the platform, and this is what I do with all the portfolios when I build them. I actually go and run them in real time. All right, so the way that it works is like this. The model is called MMR. Okay, I'll just sort of give you a quick overview how it works. So the model sits in here in our builder. This is one of the conference ones that we keep as a template. There we go. All right. So basically what we would do is we would take that model and then you have to duplicate it. And then we have something called X Manager, which you'll see here. I'm going to create just a test demo account. So we'll set it up on a $10,000 account because we worked out that that could work. Okay, so there's our account. Go to our builder. And then what you can do, this is really good. It all runs in the cloud. You can go and push it to the demo trading account, to the ATAA account. We're going to select the symbols. So I'll just do a few, but you'll get the idea. So you can go New Zealand CAD. It runs on the 1 hour. Won't change any of the variables. You can add a couple more. We'll do the GBP New Zealand. And I'll just do all the rest stays the same. And I'll do the Euro Swiss franc. We can say done. And then what's going to happen is it's going to run those algos. It's going to set those algos up, and they're going to run in the cloud. So you don't need to have any VPS or anything. They just run in the cloud. And then what will happen is we're going to let those run for, let's call it a number of months, so that we can, number one, with any algos, you want to make sure they're performing correctly. Number two, you just want to make sure that their portfolio performance mirrors the what you got in the testing, which if you've done it correctly, it usually should. All right. So that's that. So they'll go and run in a demo account now, and then we can come back and we can see how they perform. All right. To give you a bit of an idea, we do a live trading room every Friday, and in here. We started up a couple months ago, so there's a few models that we set up. In here, this is one of the ones here. It's one of the Trading Talk episodes. So this one here, we've got a couple of different models running here. We're going to keep adding each week, so we haven't really built portfolios per se out of these yet. There's a couple of models in each one, but you can go and have a look and you can see how they're performing. So that one's coming along okay. All right, and that's what we'll do. We'll let them run and then make sure they're performing correctly. If we're happy with them, we'll do this. And you can push them to the live trading account, just basically with one click. So that's sort of the whole process. Obviously, backtest them, go through, pick some of the ones out that we want to add to the portfolio, put them into the analyzer, which we did before. And then once we're happy with that, we'll push it to the demo account, let them run on the demo account, and just make sure they're running the way that we think. So remember before I said, there is plenty of calculations and all sorts of bits and pieces that you can do. And we do take that stuff into consideration. But I think a lot of the things that you can do, you don't have to think too much about it. Number one, does the model work? If the model works and you understand how it works, what's the maximum exposure it can get into? again, we have some internal limits for all those things. So I already knew what they were before I made that portfolio. Push them to the analyzer, have a look at what does it look like in a portfolio. If we're happy with that, we'll set it up on the demo account and let it run. If it's running well on the demo, we push it live, and then that's pretty much it. We try not to overcomplicate it too much. So yeah, I'll open it up to you guys if you have any questions. I know we covered a lot of stuff. I was trying to go for about an hour, but I think we went for about an hour and a half. Sorry about that. But if you've got any questions, feel free. I'll put the camera on and you can ask away. All right, the slide for step 4. Yeah, I can go back to that slide. Can you guys still see my slides? All right. So step 4 was basically put together that portfolio in X Analyzer. Like I said, we built our own platform to suit exactly how we do it here. I think it's got a natural flow in there. You build it, you back test it. Um, you know, you can very easily back test on multiple instruments. It's not about just picking the ones that work. There is a little bit more of a consideration to that in relation to what type of model it is and why has it worked. But sometimes we'll find strategies that we might not think work on particular instruments that can work well. So we usually backtest across a number of different things. Once we're happy with that, push them to the X Analyzer. If we're happy with that, we run them in the demo account. If we're happy with that, we push them live. So yeah, Scott said it's impressive software. Appreciate that, Scott. Thank you. How do commissions affect which models you use? Um, Basically all that stuff is baked into the original back test. So in the back test you can test with commissions, swaps, spreads, all that type of thing. So if the back tests are good to start with, then it's already baked in, so we don't really worry too much about that. That's more worried about at the model stage, I would say. All right, I'll open it up if you guys have got any more questions. Of course, if you want to see more, look, if you want to see more, probably more about the models themselves or about different models, the conference is great. It's on next weekend, next Saturday. So we're going to be pretty flat out this week. Alan will be there. He'll be presenting. So definitely come and cheer him on. He's put the link there for you guys, which I'm sure you can chat to him about. But it'll be genuinely a really, really good event. We really go very deep with the models and been doing some good work with Alan's. Well, Alan's been doing the good work and we've just sort of helped him put it all together into our format. So yeah, you'll get to actually do all this stuff literally with Alan's models and the other guys as well.